Hello, hello, good day, viewers. Welcome back. So, in today's session of our tax series, we're shedding light on a significant tax break for homeowners, the home sale exclusion, maximizing your benefits. So, selling your home can be a milestone event, and understanding this exclusion could save you thousands in taxes. But before we get into this lovely topic of the home sale exclusion, let me introduce myself. So my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator, and I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do. That is who I help. So let's get on into this topic. So, understanding the home sale exclusion. So, the IRS allows individuals to exclude up to $250,000 of capital gains from the sale of their primary residence from their income, and up to 500,000 for married couples, but you have to be filing jointly. To qualify, you must have owned and used the home as your main home for at least 2 out of 5 years prior to the sale. So if you purchased the house in 2020, it is now 2024. So if you decide to sell the house now, you have lived in the house for at least 2 out of 5 years, even though it's technically 4 years, but you lived in it for 2 years, you have met that test. You will be eligible to take either the 250 exclusion or the 500 exclusion if your couple married filing jointly. All right. So eligibility requirements. So eligibility hinges on meeting both the ownership test and the use test, alongside not having excluded gain from another home sale within the 2-year period before the current sale. So special rules may apply if you were serving overseas or you had to sell your home due to a specific unforeseen circumstance. Okay. So let's do a case study real quick. We're going to talk about Jasmine and Alex's sale. So Jasmine and Alex, they're a married couple, and they sold their home where they lived for the past 4 years and made a profit of 400K. So given their eligibility, they were able to exclude the entire gain from their taxable income, thanks to understanding and applying the home sale exclusion correctly. So the gains was 400K. That's the profits, but because they're a couple, they're married and they're filed jointly. Remember, I just said they can exclude up to 500K of the gains. So that 400K was poof, be gone, cash money in your pocket. You don't have to worry about paying any capital gains taxes on that. All right. So reporting the sale. So not all home sales need to be reported to the IRS, especially if the sale is under the exclusion limits and meets all the criteria. However, if the gain exceeds the exclusion limit or the eligibility criteria is not fully met, reporting is necessary. So typically using a Schedule D, and you'll do that when you file Form 1040, when you file your personal or individual taxes. So if you've met all these tests, you don't have to report this on your taxes. Now, you may get a 1099-S, which stands for the sale of your home, which all the proceeds and everything will be on there. You can actually include that on your taxes. Your tax professional will do the deductions on there so that you can exclude that as income. But even if you don't receive the 1099-S, it's okay. If you sold your home and you do not meet these criteria, then you need to let your tax professional know so that they can put in these gains. Okay. But of course, if you met the test and you are excluded either the 250 or the 500, you don't have to worry about putting it on your tax returns at all. Okay. So the impact on your taxes. So the ability to exclude such a significant amount of capital gains can have a substantial impact on your annual tax liability. It can turn a potential tax event into a non-taxable one, freeing up more of your sales profits for the next home purchase or any other investment that you want to make. So I call this a win-win. Okay. Let's do another case study. So we're going to do Leo's investment property. So Leo converted his investment property into his primary residence 2 years before selling it. Although he qualified for the exclusion, he had to prorate the exclusion amount due to the time the property was not used as his main home, showing the nonsense of applying this rule. So there can be little bits of, mix and mingle going on here. So he didn't own it as a primary residence previously. It was a investment property. So when he converted it, even though it's been 2 years, he still had to exclude some of the amount. So the exclusion is going to apply. He just likely will not be able to take the full 250K. It'll be a little bit less. Okay. So of course, getting with your professional is going to be the best course of action to help you with this, so that you are not doing this on your own and messing up, because you may think that you qualify, but then you may not. Or you may think that you owe taxes on the gains, but then you may not. So you never know. The best thing to do is get with your professional, or come see me, and we can figure this out and sort it out for you. So planning for the future. If you're planning to sell your home, consider how long you've lived there and any potential gains that you might make. So strategic planning, possibly with the help of a real estate or tax professional, I say both, can help you maximize and maximize the benefits of the sale of the home sale exclusion. So definitely you want to get with your real estate agent and your tax professional. It says or, but yes, you can do and or, but I definitely recommend getting with both, because they should be a team working together to best help you when it's time to file your taxes. So in conclusion, on this short and sweet session, the home sale exclusion is a powerful tool for homeowners, offering a way to keep more of the profits from the sale of your primary residence. Knowing how to navigate these rules can lead to significant tax savings. So imagine if you purchased a house. Like I say, I purchased my house March 2022. So this March coming up is going to be 2 years. So when I file my taxes, that is due by April 15th. So let's say I sold my house March 1st. I decide to sell my house. Well, technically, I bought my house in 2022 at the end of March. If I sell it March 1st and I receive, I'm just going to make up a number, 100K in gains, I'm going to have to pay taxes on those capital gains, because I did not live in the home 2 out of 5 years. It's almost 2 years, but I didn't quite make that 2-year mark. So if I did make it to the end of March, and then I sell my house, let's say April 1st, then I would be in the clear, because I have lived in this house for 2 years. So that's just another quick example for you guys, and how even if you are short by a day, it can make or break your situation. So you want to make sure that you keep track of when you purchased the home and when you sold the home, so that you are in the clear. Now, if you purchased that house 3 years or more ago, then you likely don't have to worry about it if it was your primary residence, to go and calculate, let's see, carry the 2, subtract the 1. You don't have to worry about all of that. But if you lived in the house for less than 24 months, then yeah, you definitely want to be counting up to make sure that it made the 24 months. Or if you're short, then you will have to pay the taxes on those gains. Okay. So some teasers for the next topic. We'll be getting into multiple businesses, one for one owner. So tax management strategies. So owning multiple businesses presents a unique challenge and opportunities, especially when it comes to taxes. So you want to join me to learn strategies for efficient tax planning and management. Then that's our next session, as oftentimes many of my coaches, consultants, and service provider, we are service-based businesses. We tend to have multiple streams of income, and rightfully so, as you should. So multiple streams of income usually need some type of tax planning, or else you're going to be in big, you know what, okay? So on the next session, that's what we're going to be talking about, multiple businesses. So in closing, thank you for watching today's video on maximizing your home sale benefits. If you enjoyed this breakdown and you want more insights on insightful tax tips, Please like, share, and subscribe. Come on over to the YouTube family. And until next time, happy selling and smart saving. And I will see you on the next one.